How do you move from scattered strategies to a coherent trading system? You probably know several entry strategies and you've memorized a handful of indicators. But when you sit in front of the chart, you're still not really sure when to enter, how to manage the trade, or where to get out. Over time, decisions start to feel reactive instead of deliberate, and the process loses consistency. What most people miss is that professional traders don't win because they know more strategies. They succeed because everything they do is organized inside one clear trading system, where entries, trade management, exits, and risk all fit together. Stay with us in this video, and by the end, you'll know how to start building the first working version of your own trading system. Part 1. The real problem: trading in pieces. Most traders start the same way. One day they trade a resistance breakout, the next day they jump into an RSI divergence, and a week later they copy a price action setup from a YouTube video. The problem shows up when it's time to exit, because there's no real plan. Decisions come from emotion, or the trade stays open until the loss feels unbearable. The problem shows up because nothing connects these strategies into a single framework. There's no clear rule for when not to trade, no plan for what to do once price starts moving, and no defined link between risk and reward. Instead of building a smooth equity curve, the account just swings up and down with no real direction. Part 2. What a trading system actually means. In simple terms, a trading system means a set of clear and repeatable rules that answer 4 essential questions. It defines what gets traded and under which conditions an entry makes sense. It explains how the trade gets managed once price starts moving, sets clear reasons for where and why exits happen, and controls how much risk goes into each position to protect capital. When any one of these elements goes missing, trading stops being systematic and turns into reacting to whatever the market throws next. Part 3. Step 1. Building a clear entry framework. Most traders make the same mistake at this stage by asking which indicator works better, but the real question sits one level higher and starts with the type of market to trade. The choice comes down to trends, ranges, or breakouts, and once that decision becomes clear, entries start to form naturally. A main time frame gets defined, such as the 4-hour chart for swing traders or the 15-minute chart for intraday setups, along with the market conditions that allow trades, like only participating when a clear trend exists. From there, the setup takes shape, for example, when price pulls back into a support area while the short-term moving average stays above the long-term one, followed by a confirmation candle like a pin bar or an engulfing pattern. Filters then tighten the process, such as avoiding trades before major news or skipping setups where their stop loss sits too close relative to market volatility. At this point, the specific instruments or price level matters far less than having a logical process that works the same way every time. Part 4. Step 2. Trade management. This is where the real difference between amateur and professional traders shows up. Two traders can enter at the exact same price, yet the way each one manages the trade leads to completely different results. Before taking any entry, clear decisions already exist about whether the stop loss stays fixed or moves with market structure, whether partial profits come off the table, and what minimum outcome makes the trade worth taking. A simple and reliable framework works like this. When price reaches around 1 hour in profit, part of the position gets secured and the stop moves to break even, or the full position stays open while the stop trails behind key market swings. Because these rules exist in advance, decisions stay controlled before the trade begins, not in the heat of the moment. Part 5. Step 3. Exits, where the equity curve is shaped. Exiting a trade goes far beyond simply closing a position in profit, because exit rules directly shape long-term results. A complete system defines 3 types of exits, starting with a loss exit that follows market structure or volatility rather than random numbers. Then a profit exit that uses fixed risk to reward targets or key technical levels. And finally, a time or condition-based exit that closes the trade when the market stops behaving as expected. When exits follow these clear rules, decisions stay consistent and emotion loses control over the outcome. Part 6, Step 4. Risk management as the backbone. No trading system survives without risk management at its core. Professional traders treat risk and position sizing with the same importance as entries because control over losses keeps the system alive. That approach usually means risking a fixed percentage on each trade, often somewhere between 0.5% and 1%, and sizing positions based on the distance to the stop loss rather than on personal confidence. Clear rules also define a maximum acceptable drawdown, where trading pauses, performance gets reviewed, and exposure gets reduced. On top of that, correlation matters, because multiple trades in the same direction across related instruments don't act like separate positions, they combine into one large source of risk. Part 7. Turning all of this into one system. The final step brings everything together into a single structure, which is exactly why professional traders write a trading plan. That plan clearly defines the markets and the timeframes to trade, the conditions that allow participation, the rules for entry, trade management, exits and risk limits, and the process for review and improvement through journaling and testing. Once all of this exists in one place, trading stops jumping between disconnected ideas and starts following a coherent, repeatable system. When trading knowledge feels disconnected, it usually means the system hasn't fully taken shape yet. Building that structure around 4 core pillars, entry, trade management, exit, and risk, brings clarity to decisions and replaces reactive trading with a consistent, systematic process. Now, take a moment and try to explain the current trading system in one simple sentence. If that sentence doesn't come easily, that's a clear sign a real system isn't in place yet.